In the world of modern finance, some of the most powerful institutions are not widely known by the public. Most people recognize the names of major banks or famous investment companies. But behind the scenes, there are specialized trading firms quietly operating at an enormous scale. These firms process large volumes of trades across global markets every single day, often with very little public attention. One example frequently mentioned in financial discussions is a company known as Jane Street. While it does not receive the same level of public visibility as traditional banks, industry reports suggest that firms like this handle an extremely large amount of trading activity. In some estimates, a meaningful portion of stock trades in the United States may pass through trading systems operated by similar institutions. But the real story goes beyond a single company. It highlights a larger structure within the modern financial system, one where specialized firms, advanced technology, and complex trading strategies all interact to move enormous amounts of money around the world. Many of these firms focus on what is called market making. In simple terms, market makers help keep financial markets running smoothly by continuously offering to buy and sell assets such as stocks, exchange-traded funds, or other financial instruments. This constant activity helps create liquidity, which means buyers and sellers can complete trades quickly. To operate at this scale, large trading firms rely heavily on advanced mathematics, data analysis, and powerful computer systems. Algorithms analyze price movements, market trends, and trading patterns in fractions of a second. These systems can process massive volumes of information far faster than any human trader. As a result, a large portion of trading in modern markets is influenced by automated systems and institutional strategies rather than individual investors. This raises an interesting question. If a relatively small number of highly sophisticated firms handle a large percentage of market activity, how much influence might they have over the flow of money within the financial system? Some analysts believe that large trading firms can play a significant role in shaping short-term market movements simply because of the volume they process. When billions of dollars move through a small group of institutions every day, their trading activity naturally becomes part of the overall market behavior. This discussion becomes even more interesting when looking at newer markets such as Bitcoin and other digital assets. As traditional financial firms continue expanding into these areas, the same systems, algorithms, and institutional strategies may also begin interacting with cryptocurrency markets. Understanding how these financial structures operate offers an important perspective on how modern markets function, not just in traditional stocks, but across the entire global financial ecosystem. Part 1. Understanding quantitative trading firms in modern financial markets. Not all major players operate like traditional banks or investment funds. Some of the most active institutions belong to a category known as quantitative trading firms. These organizations focus on data, mathematics, and technology to participate in global markets. One well-known example within financial circles is a firm called Jane Street. Founded in 1999 and headquartered in New York, the company has grown into one of the largest quantitative trading firms in the world. While its name may not be widely recognized by the general public, discussions in the financial industry often highlight the scale at which firms like this operate. Unlike traditional investment banks that provide services such as lending, corporate advisory, or wealth management, quantitative trading firms concentrate heavily on market activity and trading operations. Their approach relies on advanced mathematical models, complex algorithms, and high-speed computer systems. Modern financial markets generate enormous amounts of information every second, including price movements, trading volumes, and order flows across different exchanges. Quantitative firms build sophisticated systems designed to analyze this data rapidly. These systems search for small pricing differences between markets, assets, or financial instruments. Even tiny price gaps can become meaningful when trades are executed in very large volumes. Another important function performed by many quantitative trading firms is market making. In financial markets, liquidity is essential. Liquidity refers to how easily assets can be bought or sold without causing large price swings. Market makers contribute to this process by continuously placing buy and sell orders, helping markets remain active and efficient. Organizations like Jane Street employ thousands of professionals around the world. Many employees come from highly technical fields, such as mathematics, physics, statistics, engineering, and computer science. Their work often involves designing algorithms, managing risk systems, and maintaining complex trading infrastructure. The firm's activities extend across many types of financial assets. These include stocks, exchange-traded funds, ETFs, options, commodities, and increasingly digital assets, such as cryptocurrencies. Because of this specialized structure, quantitative trading firms often operate with far less public visibility than large banks or well-known investment companies. Their work typically happens behind the scenes, within the technical infrastructure that supports modern financial markets. Understanding how these firms operate provides valuable insight into how large volumes of money move through today's global financial system, and how technology now plays a central role in shaping market activity. Part 2. The role of market makers. Modern financial markets rely on a complex network of participants working behind the scenes to keep trading active and efficient. Among the most important participants are institutions known as market makers. Market makers play a central role in maintaining the smooth operation of financial markets. Their primary function is to continuously offer both buying and selling prices for financial assets. These assets can include stocks, exchange-traded funds, ETFs, options, commodities, and increasingly digital assets, such as cryptocurrencies. By constantly posting prices on both sides of the market, market makers help ensure that trading can occur at almost any moment during market hours. This process creates what financial professionals call liquidity. Liquidity refers to how easily an asset can be bought or sold without causing large or sudden price changes. In a liquid market, buyers and sellers can enter or exit positions quickly because there are always active participants ready to take the other side of a trade. Without this continuous activity, markets could become much slower and less efficient. If there were long gaps between buyers and sellers, price movements might become more extreme, and completing trades could take significantly longer. Market makers help reduce this problem by staying active in the market throughout the trading day. Firms that specialize in market making often use advanced technology to manage this process. Their trading systems monitor thousands of securities across multiple exchanges at the same time. Sophisticated algorithms analyze market data, adjust prices, and update trading positions in fractions of a second. This technological advantage allows large trading firms to react quickly to changes in supply and demand across different markets. Another important part of market making involves risk management. Because market makers frequently hold positions while facilitating trades, they are exposed to potential price movements. To manage this exposure, many firms use strategies designed to balance positions across different markets or financial instruments. This approach is often referred to as hedging, where activity in one area of the market may offset changes in another. Through a combination of constant pricing, rapid trade execution, and structured risk management, their presence helps markets remain active, allows prices to adjust more efficiently, and supports the enormous trading volumes that flow through global financial markets every day. Part 3. Understanding Bitcoin ETFs. In recent years, Bitcoin has entered a new stage in its evolution within global finance. What once existed mainly within technology communities has gradually become connected to the broader financial system. One of the most significant developments in this transition is the introduction of Bitcoin exchange-traded funds, commonly known as ETFs. An ETF is a type of financial product that trades on stock exchanges, similar to a regular stock. Instead of representing ownership in a company, however, an ETF represents exposure to a specific asset or group of assets. In the case of a Bitcoin ETF, the fund is designed to track the price of Bitcoin. This structure allows investors to gain price exposure through traditional brokerage accounts rather than directly buying and storing digital coins themselves. Within the financial system, ETFs operate through a specialized mechanism that helps keep their prices aligned with the value of the underlying asset. A key part of this mechanism involves institutions known as authorized participants, often abbreviated as apps. Authorized participants are typically large financial institutions with the ability to interact directly with the ETF issuer. Their role is essential in maintaining the balance between the ETF's share price and the value of the asset it represents. They can perform two main actions within the system. The first is the creation of new ETF shares. When demand for the ETF increases, authorized participants can deliver the underlying asset, such as Bitcoin, to the fund in exchange for newly created ETF shares. These shares can then be introduced into the market where investors trade them. The second action is the redemption of ETF shares. When the number of shares in circulation becomes higher than market demand, authorized participants can return ETF shares to the fund and receive the underlying asset in exchange. This continuous process of creation and redemption helps keep the ETF's market price closely connected to the value of Bitcoin itself. However, this role is limited to a relatively small number of institutions. Only approved participants with the necessary infrastructure, capital, and regulatory relationships are able to perform these functions. In many cases, large trading firms and major financial institutions act as authorized participants. Their involvement connects the cryptocurrency market with traditional financial systems, creating a bridge between digital assets and the broader investment landscape. Understanding this structure provides insight into how modern financial products allow different markets to interact while maintaining price stability and liquidity. Part 4. Hedging and complex trading strategies in large financial institutions. Trading activity often looks very different from the way individual investors typically imagine it. Instead of relying on simple predictions about whether an asset will rise or fall in value, many professional trading firms structure their positions in far more complex ways. One widely used concept in institutional finance is hedging. Hedging refers to building positions that balance risk across different parts of the market. The idea is to create a structure where potential losses in one area may be offset by gains in another, rather than depending entirely on a single price movement. Firms attempt to spread exposure across multiple instruments or markets. This approach is commonly used by large trading firms, hedge funds, and market-making institutions. For example, a trading firm might hold a position in Bitcoin while also participating in related markets such as futures contracts. Futures markets allow traders to agree on a price for buying or selling an asset at a later date. When both positions exist at the same time, the firm can manage how much exposure it has to changes in price. In some cases, this structure allows institutions to take advantage of price differences between markets. Because financial assets often trade on multiple platforms around the world, small variations in price can occasionally appear. Sophisticated trading systems monitor these differences and execute transactions designed to capture those gaps. Another strategy, often discussed in professional trading environments, is known as delta-neutral trading. In simplified terms, delta-neutral strategies attempt to build positions that reduce sensitivity to the overall direction of the market, instead of depending on whether an asset rises or falls. The structure focuses on market inefficiencies, pricing imbalances, or temporary gaps between related financial instruments. This type of strategy often involves combining different financial tools such as spot assets, derivatives, or options. By adjusting the size and structure of each position, the overall exposure can remain relatively balanced. These techniques are not unique to cryptocurrency markets. Similar strategies have existed for decades in traditional financial sectors, including equities, commodities, and foreign exchange markets. Large trading firms rely heavily on advanced technology, mathematical modeling, and automated systems to manage these complex positions. Their trading platforms analyze market data continuously, adjusting positions as conditions change. Understanding these strategies offers insight into how institutional trading operates behind the scenes and how sophisticated structures can influence activity across modern financial markets. Part 5. Why price movements can sometimes look unusual. Financial markets do not always move in smooth or predictable patterns. At times, price charts show sudden shifts that appear unusual or difficult to explain at first glance. These movements can include rapid price increases, sharp declines, or brief periods of intense volatility. In many cases, these patterns are not the result of a single factor. Instead, they emerge from the interaction of many different market forces operating at the same time. One example involves specific moments during the trading day when market activity naturally increases. The opening and closing periods of major exchanges often bring a surge in orders as institutions adjust their positions. During these times, large volumes of transactions may occur within a short window, which can cause noticeable price movements. Another factor comes from economic announcements and financial news releases. Reports related to inflation, employment, interest rate decisions, or broader economic indicators often attract immediate attention from financial markets. When new information becomes available, trading systems and institutional participants may quickly adjust their positions, leading to short bursts of volatility. Technology also plays an important role in modern market behavior. A large portion of global trading activity is now carried out by algorithmic systems. These automated programs monitor prices, trading volume, and other signals across multiple markets simultaneously. When certain conditions are detected, algorithms may execute trades within fractions of a second. Because many firms operate similar systems, multiple algorithms can react at the same time, occasionally amplifying price movements. Institutional portfolio adjustments can also influence short-term market behavior. Large investment funds regularly rebalance their holdings in order to maintain specific allocations. When billions of dollars are being repositioned across markets, the resulting order flow can temporarily shift supply and demand. In highly active markets, such as Bitcoin, these effects can become even more noticeable. Digital asset markets operate globally and around the clock, with participants trading on many different exchanges. Even modest changes in buying or selling pressure can sometimes trigger larger reactions in price. Another element that can increase volatility is the presence of leveraged trading. In leveraged positions, traders borrow funds in order to increase the size of their market exposure. If prices move against those positions, the borrowed trades may be automatically closed by trading platforms. These automatic closures are known as liquidations. When multiple liquidations occur in a short period, additional buy or sell orders can suddenly enter the market. This chain reaction may cause price movements to accelerate temporarily. Taken together, these factors help explain why financial markets sometimes display sharp or unusual price behavior. The combination of technology, institutional activity, and global trading participation creates a fast-moving environment where prices can respond rapidly to new information and changing market conditions. Part 6. Regulatory actions and market oversight. Financial markets operate within structured legal frameworks designed to maintain fairness, transparency, and stability. because billions of dollars move through global markets every day. Regulatory oversight plays a critical role in monitoring trading activity and enforcing financial rules across the world. Different countries maintain regulatory agencies responsible for supervising financial institutions, exchanges, and trading practices. In the United States, several organizations oversee various aspects of financial markets. These regulators examine trading data, monitor market behavior, and investigate situations where unusual activity appears. Their objective is to ensure that markets function in a way that protects investors while maintaining confidence in the financial system. When regulators detect patterns that raise questions, such as abnormal trading volumes, suspicious price movements, or potential violations of financial laws, they may open formal investigations. These investigations often involve reviewing large amounts of trading data, communication records, and internal company processes. Because modern financial markets operate through highly sophisticated technology, analyzing these cases can require extensive technical expertise. If authorities determine that rules have been violated, several outcomes may follow. Regulatory actions can include financial penalties, which may involve significant fines imposed on institutions or individuals. In other situations, regulators may impose restrictions on trading activities, limiting how certain firms operate within the market. More serious violations can result in temporary or permanent trading bans, preventing individuals or organizations from participating in certain financial activities. In some cases, investigations may also lead to legal proceedings if authorities believe that laws were intentionally broken. These enforcement actions serve an important purpose within financial systems. They help maintain trust by demonstrating that markets are monitored and that participants are expected to operate within established rules. However, the structure of modern markets has become increasingly complex over time. Many trading firms rely on advanced algorithms, automated systems, and high-speed infrastructure that process enormous amounts of data in fractions of a second. Strategies often involve multiple exchanges, financial instruments, and international markets operating simultaneously. Because of this complexity, much of the underlying activity happening inside financial markets can be difficult for the general public to fully understand. Even experienced observers may find it challenging to interpret every detail of how large institutions manage their trading operations. Despite these challenges, regulatory oversight remains a key component of modern financial systems. Continuous monitoring, investigations when necessary, and enforcement of established rules help support transparency and maintain confidence in the markets that connect investors, institutions, and the global economy. Part 7. The bigger question surrounding Bitcoin. When Bitcoin first appeared in 2009, it introduced a new idea to the world of finance. The system was designed to function without a central authority, such as a bank or government institution. Instead, transactions could occur directly between participants through a decentralized network supported by blockchain technology. The original concept behind Bitcoin focused on creating a financial system where individuals could store and transfer value digitally without relying on traditional intermediaries. Every transaction is recorded on a public ledger. In its early years, Bitcoin was mostly discussed within technology communities, academic circles, and small groups of enthusiasts interested in cryptography and digital innovation. Over time, however, the landscape began to change. As awareness of digital assets expanded, larger financial institutions started paying closer attention. Investment firms, hedge funds, and asset managers began exploring ways to interact with the cryptocurrency market. Gradually, Bitcoin became connected with parts of the traditional financial infrastructure that had long existed in global markets. This shift introduced a new dynamic. On one side, institutional participation can increase market liquidity. Liquidity refers to the ability to buy or sell an asset easily without causing dramatic price changes. When large institutions enter a market, the amount of trading activity often increases, which can make markets more accessible and efficient. Institutional involvement can also expand global access. Financial products such as exchange-traded funds and regulated trading platforms allow Bitcoin exposure to appear within traditional investment environments, including brokerage accounts and retirement portfolios. At the same time, the growing connection between Bitcoin and traditional finance introduces additional layers of structure and influence. Large institutions often operate through sophisticated trading systems, regulatory frameworks, and financial products that add complexity to how markets function. These structures can shape how capital flows into and out of the cryptocurrency ecosystem. As a result, Bitcoin now exists at the intersection of two different financial worlds. One side reflects its decentralized origins, where individuals interact directly through blockchain networks. The other side involves institutional systems, market infrastructure, and global financial organizations that bring scale, regulation, and technological resources. This ongoing evolution continues to influence how Bitcoin markets behave today. The interaction between decentralized technology and traditional financial systems remains one of the most important developments, shaping the future of digital assets and modern finance. Final section, understanding the bigger picture. The discussion in this video is not centered on a single company or one specific institution. The broader focus is on how the modern financial system functions as a whole. Today's global markets operate through a vast network of participants and technologies working simultaneously. Large financial institutions, trading firms, exchanges, regulatory agencies, and automated systems all play different roles within the same ecosystem. Together, these components form the infrastructure that supports modern financial activity. Behind every trade that appears on a price chart, there are layers of processes happening in the background. Advanced computer algorithms analyze market data at extremely high speeds. Trading platforms connect buyers and sellers across different countries. Regulators monitor activity to maintain transparency and fairness. Each of these elements interacts with the others, creating a complex environment where money moves continuously across global markets. Because of this complexity, price movements are rarely influenced by a single factor. Market behavior can reflect a combination of institutional decisions, economic news, technological systems, and changes in investor sentiment. Understanding these interactions can provide a clearer perspective on why financial markets sometimes behave in unexpected ways. This type of knowledge is especially useful when looking at rapidly evolving areas of finance, including digital assets such as Bitcoin. As cryptocurrency markets continue developing, they increasingly intersect with the same financial structures that exist in traditional markets. The goal of this video is purely educational. It aims to explain how certain parts of the financial system in the United States operate and how different institutions interact within that system. Nothing presented here promotes or encourages any financial activity, and no interest-based transactions are being suggested or endorsed. Financial participation is a personal decision that depends on individual circumstances, risk tolerance, and professional guidance. Anyone exploring financial markets typically gathers information from multiple reliable sources and may consult qualified professionals when evaluating complex financial topics. If this explanation provided useful insight into how modern financial systems operate, engagement with the channel helps support the creation of more educational content. Viewers often participate by liking the video, subscribing to the channel, sharing the discussion with others, and leaving comments that add thoughtful perspectives to the conversation. These discussions help expand understanding of the financial world and encourage more informed conversations about how global markets function today.